You might want to watch this. You guys might want to watch this. All right, so give me the MSCI X. Is that the ticker?
I think so, yeah.
So you got the MSCI, is it the MSCI X or is it global or what's the actual?
The one I clicked on was MSCI World.
MSCI World, does that have the US in it? Does that include the world or the global? Can you guys like try to find me some data? What? So what's the global? Does the global have it in it? Well, just give me the one that you have now, and then you can swap it out for the global index later.
I'm pretty sure it's this one, because another one says excluding USA.
Okay, perfect. Which one is that? Give me the ticker on that.
With USA?
No.
With that?
Yes.
Okay.
Which one's that? Is that the global?
Can't go with that one. It looks like it's 1 year ago or something.
Ticker is what, ACWI?
What is it? What's the ticker?
ACWI.
ACWI, is that it?
Yep.
Is that an ETF or is that just or is that the index itself?
I think it's the index itself.
Okay, perfect. So give me, we want January 1st, 2019, and we want January 1st, 2018. So can you give me the indexes? Do you know how to calculate average annual compound growth rates? Do you know how to calculate average annual compound growth rates?
No.
No. Do you think you know how to, you should know how to calculate average annual? Yeah, you need to know this. You can't just take, oh, hey, Ken, will you do me a favor and calculate the 3-year average for the global index? Great. So I calculate the percentage change and I divide it by 3. That's wrong. Okay. You have to calculate it using the average annual compound growth rate. Okay. That's what we use in finance to calculate performance. So can you give me the January 1st, 2019 index level, Sam, please?
Yeah, January 1st, 2019 was at $255.42.
$255. So it is a, this is an ETF, or is it an index?
It says it's an index.
Okay, and then can you give me January 1st, 2018? Hey, can you break out your calculators? Unless you can do this stuff in your head.
$305.
305.
And 62 cents.
62, 1 divided by 1, minus 1 times 100. You may want to write that formula down. This is just 1 year, but when you see we do the 3 and the 5 and the 10, it'll be a little bit more valuable. So can somebody calculate this ratio for me, please?
0.835.
What is it?
2 decimal points or 3?
Just 2.
0.84.
So 0.84. Got it. 1 divided by 1 minus 1 times 100. Got it. What's 1 divided by 1?
1.
0.84 minus 1. What do we get? What is it?
Negative 0.16.
Negative 0.16. Got it. Times 100.
Negative 16.
What is it?
Negative 16.
Got it. Okay, so that's what the, and they should have, in that, if you're looking there, they should also give you in the fact sheets on those things, they should give you the 1, 3, 5, 10, so you can confirm that we're calculating it correctly. Okay. So it basically says that in the last year that the index has dropped 16%. Does that make sense? Do you think that's happened? Is Europe booming right now? Is it, you know, in the recovery growth phase of the business cycle? Is Brexit a done deal? Is Germany not in a recession? Germany is in a recession. The Brexit deal is an issue. You know, most of Europe's in a recession, so this just confirming this probably is true. Okay. So you could use just, intuition, you can use inductive reasoning to basically validate this, and then you can go look it up someplace else to validate that it's close, okay? So what about the 3-year? How do you calculate the 3-year average annual compound growth rate? So what would I do? Here, how would I modify this? Just gonna testing your mathematics, go ahead.
Do you add, the change year over year and then put it to the power of 1/3?
Got it, okay, so are we gonna change this date? Is the numerator gonna change? No. And then how far back do we go? January 1st to what?
2016.
2016, got it. Can you give me the index level? What was the index level? Oh, I already have 2019. So 255.43 divided by, what was the index level as of January 2016? Am I going too fast for you? Is everybody following along the mathematics? Okay. This is critical. This is extremely crucial because you'll be going in and they'll be asking you to calculate stuff, and if you use the average divided by 3 to get this, you're wrong. Okay. So you got to learn how to be able to do this stuff either by hand or obviously in an Excel spreadsheet. So what was the January 1st, 2016 index level? Sam, do you have it?
I'm trying to get it back up because I found the fact sheet.
Oh, okay, so you're floating around. Does anybody have that number? Is everybody following along? Are we doing all the work for you guys? Are you guys looking on the website? Are you looking up the ticker? Are you going to the data? Are you getting, because remember, this class is, a lot of it's research, right? It's research. So either I go through the book and give you a multiple choice exam and move on, or we do real live research where we can actually apply this stuff in a real setting. And I have an actual global portfolio manager coming after the quiz, and he's gonna walk us through how he constructs global equity portfolios. Okay. So Elizabeth, do you got the number? Okay. Are we like in the real world, are we hyper, and do we want information like as soon as possible? And I got 30 analysts or 20-something analysts in this room right now, so I should be able to get to the data within like 2 minutes. Don't you think? Yeah. I'm just putting some pressure on you, because that's what the real world's all about. So did anybody got the numbers? You got any numbers?
January 1st, 2016 was $242
242.
and 35 cents.
35, got it. And then what's this become? What's this become?
1/3.
1/3. Got it. 3 minus 1 times 100. Am I doing this right, or am I calculating it incorrectly? Okay, so what's 255.43 divided by 242.35? Do you guys have calculators?
1.05.
Thank you. 1.05. Is that correct? 0.333 minus 1 times 100. So what's 1.05 to 0.333? Did I do that right? 1 divided by 3 is not 0.33? No, what is it?
I was always taught that when it's an exponent, like, that you would square by the 3rd root.
So what's divided by 1 divided by 3? I can do that probably too, but this is another way of doing it. So what's 1 divided by 3?
0.3.
Okay, so I got it. So what's 1.05 to the 0.333? Exponent. Gotta get your
1.106.
calculators out. Finance people, gotta have your calculators.
1.10.
Is it?
It's 1.016.
1.016? Is that what you said?
Yes.
Okay. Do I need to go any further to get the answer? I mean, do I need to really go any further to know what the answer is? 16%, right? Do I need to go through all those other steps? You should be able to do it.
6%.
What is it?
1.6%.
Oh, that's right, nice job. We got fired, okay, that makes sense, doesn't it? So let's do the 5-year. So what you want to do is plug that into your worksheet. What I would do is program it in there so that you're not hard coding it. Okay, so that's all you got to do is add the index levels at any point in time in the future, and it'll just calculate the average annual compound rate. So 5-year. So what are we using? January 1st, 2019. What are we using January 1st? 14? 2014? Is that right? 14, 15, 16, 17, 18, 19, yeah. 4, okay, can you give me those? And what's the exponential? 1/5, got it. And then what are we dividing? We got 255.43. Divided by what? Can you give me the index level for 214? What website are you using, Sam, to pull up the data?
I'm just using the MSCI website.
Perfect. And then you just typed in what, ACWI,
Yeah.
and it gives you the time series.
I typed in my current price and it took me to like a bunch of different indices that I have.
Awesome. Can you give me the January 1st, 2014? Anybody else have this number? Everybody should be up on the website digging around for the data. Are you up on the website? Are you at the website? Are you at the website? You're at the website? Okay. Should be at the website. That's why I got the room with the computers. So you guys can be learning how to dig around and get information. Basically, research people dig around. We get data, we do analysis. We try to make money in our careers. Anybody got the January 1st, 2014 number? Hello? Anybody?
What's on the 5-year? And I'll go back to March 4th.
Looks like there's a different level.
Third up history, Sam?
January 1st,
Yep.
you can get January 31st.
Yeah, let's
That's
get
fine.
January 31st.
It doesn't matter.
Alright, 268
268,
and 10 cents.
10, got it. So what's that? What's this? You guys have a calculator? Can you calculate this for me?
1%.
What is it?
1%.
How much?
Wait.
Negative 1%.
How can it be? Oh, did you already do
I just
mathematics?
put it in the.
You put it in the formula? Oh, you already did it? So you went through everything? Well, I just want to double check it, because a lot of people need to go through this mathematics. What is it?
0.95.
0.95, got it. And then, what's 1 divided by 5? What is it then? 0.2 what? 0.2. So it's 0.95 to the 0.2 exponential. What is it?
199.
0.99 minus 1 equals what? 0.01 times 100.
Well, it's negative, sorry.
Is it? Okay, negative 0.
Zero.
Negative 1.0%. That's all right. And you may want to just verify that, but I mean, they calculate this stuff all the time. So there's your 5-year. Is that good?
Yeah.
That's good? Really?
Yeah, we should get another.
It's been down basically 1% per year for the last 5 years. That's good.
No, not especially the compounding is not good.
No, it's not good. Okay. Do you think you're gonna, beat the benchmark?
Hopefully.
Yeah. Well, you better. We hope you do. It's gonna be really hard to, sell a portfolio, a global equity portfolio that has basically matched the index of -1% over a 5-year period. They're not gonna, nobody's gonna be happy. Okay. You can't sell this. You're not gonna be able to sell it. Okay, and then what's this one? January 1st, 2019. Got it. And January 1st. What is this? 210? Right? 210? 209?
2009.
9? Do we know what the, does the index go back that far? It should. 255.43. So what was the index level 10 years ago?
January 30th, 2009.
Yeah, I'll take it.
160, 96.
96. And what's the ratio? What is it? Let's just do a little test here. Is the average annual compound growth rate over a 10-year period gonna be positive?
Yes.
Yeah.
And when they turn out to be fractions like this, are they gonna be negative? You get something like this, is it gonna be positive? You get something like this, is it gonna be negative?
Yes.
Yeah, so you can check your numbers as you're doing it. Okay. So what's 1.59 to the 1 exponential?
1.047.
0.047, does it tell you right there what it is? So what is it? What was the average annual compound growth rate?
4.7%.
Got it, exactly. So -1, you get 0.047 times 100, it's gonna give you 4.7%. Do you think you can beat the benchmark? Yeah. If you get 8%, and it's been 5, you're gonna beat the benchmark by 300 basis points. That'll be awesome. And actually, your global portfolio, your betas are probably gonna be, are your betas gonna be higher or lower than 1 for a global equity portfolio? Do you think your beta's gonna be higher or lower than 1? Well, okay, if you're large cap, mid cap, diversified, defensive, probably gonna be lower. You're probably not gonna get negative on this. When we do the fund of funds, you'll probably get a negative fund of funds beta, but you'll probably have probably a pretty low beta, unless you're doing small cap tech on a global basis.
A couple negatives.
Huh?
Yeah, a couple negatives.
Maybe, yeah, maybe, yeah.
So if you're doing mid to large cap, do you also do lower beta?
No, you look at the beta, actually, is the calculated beta gonna give you an idea of the systematic risk of your portfolio? Yes or no? Am I talking foreign languages here? Is the beta gonna give you an idea of the weighted beta of your portfolio gonna give you an idea of the systematic risk of your portfolio?
Yes.
Yeah.
And if the systematic risk or the beta is low, what do you expect the returns to be? What do you think the expected return's gonna be, high or low?
Lower.
Low, exactly. So you have to look at it like that. If you can get diversification in lower betas, in like the 0.5, 0.6 range, and you're getting 8%, is that pretty good? If I'm getting half the systematic risk, of a market, and I'm hitting the 8 to 10% target, and our portfolio is gonna double in less than 10 years, is your investors gonna be happy about that? Yeah, you got a return and you lowered the risk of the portfolio. They love that stuff. I mean, that's the name of the game. Okay, so does everybody understand how to calculate and program the average annual compound growth rates? You know, in your, so you need to put that in so that you can benchmark and back test your portfolio and calculate the alpha. Okay, and you gotta be able to calculate the weighted beta. Now, I saw some portfolios with some stocks. Eleanor, do you think your weights were correct? No, were they wrong? You do? Has anybody calculated the weights in the target portfolio worksheet? Have you calculated your weights yet? Do you have your weights available? Okay, everybody should have, gotten to the strategy by now. Put in the companies by sector allocation, by country, and then at least have the target portfolio worksheet done with the scaling factor. Okay, either the market cap or the revenues, if that's what you're using. So who's already done that? Who's already got the first sheet done? Okay, perfect. Okay, perfect. What's the highest portfolio allocation within your portfolio? What stocks have the highest portfolio weights?
Yeah, we did tech stock at 38%.
What is it?
Tech stock, semiconductor company,
Okay, so you got one company that's got how much?
38%.
38%, okay. And then what do you guys have? What's your highest stock allocation?
So you're talking about the total weights, right?
Yeah, of all the weights that were calculated based on, did you guys use market cap or revenue?
We use revenue.
Revenue, okay. You did, okay, so what company or companies have the highest allocations within the portfolio?
Ours is an energy company, 16%.
Okay. Anybody else? Or you got another?
Oh, well, the next one was 14%.
Okay. Anybody else have any allocations? No? Would you want to have 36% of your portfolio in one stock? No. You're not getting diversification. So you're going to have to set some maximum limits. So what do you want to set as the maximum limits for your portfolio allocation? See, what you're going to have is you're going to have a bunch of stocks that have 36% and 22%. Then you're going to have a bunch of stocks that have 0. Why would you? The board's going to ask you, well, why do you have 36% and 22% allocations in 2 stocks and have no allocations in the other? Why do you have them in your portfolio? Okay, so you're going to have to set maximum. So what do you think should be the maximum exposure to any one stock within your portfolio?
15.
Maybe 10, maybe 12, maybe. You're going to have to come up with it. 22 is too high. 15 is probably a little high. 12 is probably about right. 10's cool because then you're diversifying. What you do is you put in the revenues or the market caps. You let the portfolio allocate just the way it is. And then when you see that there's 2 companies or 3 companies that are getting the majority of the weights, you go right to their revenues and you start taking them down. Okay? You start taking them down until you get to your maximum allocation. What will happen is the portfolio, the way that the math is set up, is once you take down the revenues, it'll recalibrate and redistribute the weights to the other stocks within your portfolio. Okay? And then what you'll do is you'll bring those guys down. Maybe another stock will be up there. You start taking them down, so you start calibrating basically the weights to bring them in line so that all of your smaller stocks are getting some weights for justification purposes. And then you might even want to set some kind of minimums, okay? Maybe some minimums too. So minimum, maximums. You might have to bring down the top weighted companies to set the minimum so you have at least 1 or 2% of your portfolio has to be, you have to have at least 1 or 2% in every stock that's in your portfolio. Maybe 1, okay? 2 is probably better. So a maximum of 12, a minimum of 2. Basically, you just start playing with those revenues. I mean, obviously, you can do an optimization procedure that would do that for you, but I think it's just easy for you to just play with those revenue numbers and get them calibrated and come up with a weighting, passive weighting scheme that, that where you don't have any number of stock or stocks that have significantly majority of the weights, and you don't have any stocks that are underallocated in the portfolio. That'll create a nice diversified portfolio, and and you should be able to see some decent returns out of that. Okay? Does everybody understand that strategy? Okay, cool. Okay, all right. All right, so let's do the, how much time do I have? How much? 23? Okay. Let's do the modern global portfolio diagram in the pretest, okay? Now, it's theoretical, but it's valid. You may someday go, wow, Professor Souza was such a great professor. I want to be a professor. And one of these days you'll have to get up there, if you do decide to have an occupation like mine, ours, you might have to go up to the board and be able to diagram this stuff, which is a little old school, because everybody just uses clickers and PowerPoint presentations, but someday you may not have a PowerPoint or a laptop, and you're in a meeting, and you're gonna have to diagram the stuff a little more. And actually, you should start thinking about that. You will need to, I lecture you guys this all the time. You guys are gonna need, Ken, when you get a chance, you guys are gonna, you can whisper, okay? You're gonna need to speak up in these meetings, okay? You're gonna need to participate, you need to take notes, and then when asked and when not asked, you need to jump up on the board and start diagramming stuff, because they can't read your mind, okay? So when you're explaining stuff, it's gonna be hard for them to understand. They need to see diagrams, they need to see cognitive images that are put up on the board. So you're gonna have to learn how to do that stuff, okay? Because we whiteboard stuff all the time. When I'm developing, index products, and when I'm developing, predictive indicators, I walk in, and the CTO and myself and the product developers are basically schematicking stuff up on the, or whiteboarding it on the board until we get it. And then we'll take pictures of it, give it to the programmers will then program it, they'll back test it, they'll give us the results, and then we work back and forth to calibrate it. So you're gonna need to work on, obviously my handwriting's not the best, but you're gonna have to work on your diagrams and be comfortable writing stuff up on the board, okay? So the question is modern and postmodern global portfolio theory. Obviously, that's on page 3. That's page 3 of the quiz, and it is page 19 of pretest. Okay. Now, this is a really important thing to understand, is when you're building global portfolios, a multi-asset global portfolio. What am I talking about when I talk about multi-asset portfolio? Can you give me an idea of what that is? What is a multi-asset portfolio?
Fixed income, equities, and real estate.
Exactly, or commodities, or derivatives, or it's the investable universe, okay? So that's your multi-asset portfolio strategy. And then I can build a stock portfolio, an equity portfolio, a fixed income portfolio. I can get diversification gains out of it by diversifying across different countries, sectors. I can do the exact same thing. But the multi-asset portfolios are aligned with large institutional investors, particularly pension funds and endowments. And the consultants, who are you guys, the consultants are the people who do all of this portfolio work that then come up with the recommendations to the pension advisor, the pension plan sponsor, and then what they'll do is they'll come up with the allocations of the portfolios and then send out RFPs and RFQs, requests for proposals, or requests for qualifications, to then have the advisors bid on that allocation, and if they win it, then they're in charge of deploying the capital within that sector, within that asset class. Does that make sense? Okay. So the multi-asset portfolio on a global basis is even more important. Now, there's really two questions here. One is, what is the efficient frontier in the multi-asset portfolio look like in a positive interest rate environment and a negative interest rate environment? The assumption, I guess, for the last 50 years prior to 2007 was that risk-free rates on a global basis would always be positive. After the financial crisis, when interest rates went to zero and negative, we had never seen those before. We've never lived in a negative interest rate environment for the last 10 years like we have. So things are totally different now. And the math books and the finance theory can't handle this stuff because they really don't understand how to operate in a negative interest rate environment. So your risk-free rate is assumed to be positive. This is the expected return on your portfolio, and we know that this is global, where we're going. And this is your portfolio standard deviation, global. This is your capital allocation line, or CAL. And you've probably seen this in the book. As you're working through the book, you're seeing a lot of this stuff over and over again. And this is how I would write it up. If I was to teach somebody this is how I would do it. Set it up first, set up the capital allocation line, go right to the market basket, set up the efficient frontier umbrella, and bam, there's your 100% stock. And this is your 100% bonds. This is your market portfolio. There's the optimal portfolio standard deviation and your expected return on the portfolio. So that's the equilibrium point. Okay, that's where you want to be. Okay. All right. So obviously, if you have a 100% global stock portfolio, you're going to get the highest rate of return, but you're also going to get the highest risk. And then if you're doing a 100% global bond portfolio, is the expected returns here on a 100% global bond portfolio extremely low currently? If I'm building a Asia fixed income portfolio and a European fixed income portfolio, what are interest rates in Asia and in Europe right now?
Low to negative.
Yeah, low to negative, exactly. So this could be really low, right? Got it. Okay, so if we just start off with stocks and bonds, and I want to take more risk because I want higher return. I want a higher rate of return, so I'm willing to take on more risk. I can move up the efficient frontier by reducing my allocation to bonds and increase my allocation. Increase my allocation to stocks and reduce my allocation to bonds. I can do that. Remember, any point along the efficient frontier, on the points here, or any point in here, are feasible portfolios that we can construct. So we can construct those. So I can move up, down the efficient frontier. I can build portfolios that are available to me in the global capital markets. I can also leverage the portfolio by taking on margin. Okay. I can move up. I can move off the efficient frontier. I can jump off the efficient frontier onto the capital allocation line and move up by using margin. So I can buy on margin. I can do that too. And obviously I'm going to get a higher rate of return, significantly higher risk. I can also jump off the efficient frontier and move down the capital allocation line through the process of lending. And that's what banks do. So these money center banks, JP Morgan, Goldman, Mitsubishi, Credit Suisse, Deutsche Bank, Bank of China, they'll basically make global loans. They're able to jump off the efficient frontier, move down the capital allocation line. Yes, they're gonna get lower returns, but they're gonna get significantly less portfolio risk through the lending process because the loans are collateralized by the underlying collateral. You can always, you default on the margin account, you default on the real estate, I will force you to liquidate the stock portfolio, and I will foreclose on your property and take it and sell it to basically cure the loan because you defaulted on the loan. The other thing that you want to have here are these. These are the utility curves. It's also in the book. E1, E2, E3. Do investors want to be up here? If I was an investor, would I want to be here? Would I want to be there? Yeah, why?
It's the highest expected.
I get high return and I'm getting lower risk. So obviously that's where I want to be. But they can't be there because there's no portfolios up there for them to invest in. So they're going to have to come down, they're going to have to reduce their utility to the point where the utility curves are tangent to the capital allocation line and the efficient frontier. At that point, you have the market basket. That's why ETFs are so popular these days, because basically you're producing smart beta market portfolios, index portfolios based on the market allocations. So that's there. So why would you go global? Give me a global portfolio allocation. I saw in some of the pre-tests that you had an actual global portfolio allocation. So what would be the target model global portfolio allocation? You can use the standard allocations, then we can just modify it.
40% bonds.
Are we gonna have 40% bonds? Remember global, what's this?
60%
What is it?
60% follow.
You could do that, but you're usually not gonna build a portfolio like that because most investors are risk averse. So they're probably gonna have more allocated to the bond portfolio as opposed to the stock portfolio. So a lot of you have already gone through the target portfolio allocations, just give you what we did before in 123, and then we can update it.
30.
30 stocks.
So 30% stock. Can you give me the next one?
10% real estate.
Yeah, you want to have 10% for real estate. And that's actually the target for a lot of institutional investors, although they can't get there. They can't get to 10%. They don't want to get to 10% because it takes them. If I was going to build a $2 to $5 billion global real estate portfolio, it'd probably take me three years to do it. But if I get rid of real estate and I just focus on stocks and bonds, I can allocate the portfolio in probably 3 weeks. Okay, because real estate is extremely illiquid. But direct real estate investment is a good way to diversify your portfolio. Okay, what else?
10% of the cash value of the life insurance,
Yeah, you know what?
not on a global.
It probably doesn't work on a global basis
Okay.
because insurance companies can't get life insurance on foreigners. So the insurance piece kind of blows out. Okay, but we can replace it with something else.
Would you still keep that potentially at a lower value and just leave it for the United States, just to have that on your portfolio? or
Maybe.
is that- Okay,
Maybe. I mean, we'll do a little asterisk down here.
okay.
But let's stick with these two because these will solve the problem. I think maybe investing in global life insurance companies, but you can't invest in global mutual life insurance companies because they're private.
Yeah.
And that's the ultimate diversifiers is cash value life insurance on principles.
Okay.
So it's really hard for institutional investors to do that yet.
For the 10%, can we say renewable energy?
Yeah, we could probably do alternative. And actually Deutsche Bank and some other large infrastructure companies, some of these large conglomerate banks have actually put together global infrastructure funds focusing on renewable energy, particularly in Europe and Asia, okay, and China. So that would be a great diversifier. And then the last one here that I swapped out the life insurance for, actually Matt Toscano came up with this strategy, is basically foreign currency. So you just do FX. Because can I forecast, can our research department forecast the direction of the value of foreign currencies and trade off that? Yeah, and is the foreign currency portfolio basically an asset class in itself? Yeah, so we can do that. So that's basically the target portfolio allocation. And then what are these called right here? What are these asset classes called?
Alternatives.
Exactly. Exactly, alternatives. And what's the characteristics of alternative assets? What is the characteristic of alternative asset returns compared to stock and bond returns? Why would you add these in your stock bond portfolio?
Did it bow out the efficient frontier?
It bows out the efficient frontier because the returns of the alternatives are what compared to the returns of the stocks and bond portfolio.
Low risk.
Lower risk, higher.
I'm looking for a terminology. What would I want the returns to be for alternative assets compared to stock bond returns to get diversification and a bowing out of the efficient frontier? What do I want the returns to be?
Not correlated.
Not correlated, or how else can I get diversification? One is no correlation between the returns. The other is, what's the other two scenarios of the correlation?
Low.
Low or
No.
negative, right? Low, no, or negative. So the reason why you would add these global alternatives to your global stock bond portfolio is because the rates of return of the alternative assets have low, no, or negative correlation with the stock bond returns. So no, low, negative. Correlation of returns. That's the goal of diversification. So if I add alternative assets, global alternative assets to a global stock bond portfolio, what's it going to do to the efficient frontier? Because I'm adding low, no, and negative correlated assets to other assets that are highly correlated to each other. These returns are highly correlated to each other. These returns have no, low, no, or negative correlation with each other with stock bond returns. So what's going to happen to the efficient frontier?
Bow out.
It bows out. Goes like that. So the efficient frontier bows out. And actually, if you look at the some of the empirical research, states that that you actually get higher rates of return at lower risk by building these global portfolios. But I'm going to be conservative. So when the efficient frontier bows out, what happens to the expected returns? Do they go up or down? I'm being conservative. Show me the empirical research of the either academic or industry research that when you build a multi-asset global portfolio that includes alternatives, that it actually increases the portfolio return and reduces the portfolio standard deviation. Show me that research. But let's be conservative. So if you add assets that have low, no, or negative correlation to stock bond returns, what's going to happen to the expected return on the portfolio? It's going to go down. And what about the portfolio standard deviation? When you add these alternatives to the stock bond portfolio, what happens to the portfolio standard deviation? You what? What?
Decrease?
Decreases, exactly. Does it decrease more
Yeah.
than the reduction in the expected return. Yep. So what happens to the risk-adjusted rate of return on the portfolio? Does it go up or down? So if this goes down more, this goes down, then your risk-adjusted rate of returns go up. And if I can give my investors an 8 to 10% rate of return, if I can lock that in, I can reduce this by going global and alternatives and increase this. Are they better off? Are the investors better off? Yeah, they're better off. That's the goal. Okay. So the other is, this is traditional, how am I doing on time? 2 minutes. This is traditional portfolio diversification. Okay. This is modern portfolio theory. Modern global portfolio theory. Post-modern portfolio theory. Can I bow out can I bow out the efficient frontier by adding derivatives, applying derivatives to the global portfolio? If I think that the value, the returns in the portfolio are going to go down, can I hedge off that risk by using derivatives? Can I? Yes? No? Yes. Okay. So I can do risk management. I can do portfolio insurance. I can apply financial engineering. To get the same bowing out effect. And if I thought that the indexes, I found some indexes that basically track the overall asset value by global portfolios. If I think the values of the returns on the portfolio are going to go down, what would be my derivative trades? If I found indexes that were highly correlated to the returns on my portfolio, and I think the returns are going to go down, what would be my index trades to hedge off the risk?
Right forwards.
Go ahead. It's like a,
Right.
this should be a sing-along at this point. What is it?
Right futures.
Right futures,
Right calls on futures.
right calls,
Buy puts on futures.
futures, puts, futures. If I have currencies, can I do currency swaps?
Probably.
Could I use swap contracts? I can also use swaptions, options and swap contracts. I can do those too. And am I going to have global ETFs and stocks in my portfolio, both bonds and stocks? I'm also going to have ETFs, and I'm going to have stocks and bonds. And if I wanted to hedge off that risk, what would be my derivative trades? Short, what else? Calls and can I use credit default swaps? I'm swapping credit on a global basis between different countries in Asia and Europe. Can I use credit default swaps?
Yeah.
Yep. So I can bow out the efficient frontier using financial engineering to apply portfolio insurance by using the derivatives. It also bows out the efficient frontier. So I can bow it out either through traditional modern global portfolio theory, or I can use postmodern portfolio theory to hedge off the portfolio by using the financial engineering. Okay. I'll do the technical analysis on Wednesday. Okay.